This is the second in our series of online mini conferences on ethics and investment, which replaces the physical events which we've held in previous years at this time of year. Last week we looked at the question, does ethical investment work, and concluded that it does on a number of levels. It can and does influence company behaviours. It does not need to cost in terms of investment return, and it can, with perhaps a little bit more difficulty, still provide the income return many of our clients are searching for. This week, we want to explore the question of income and how to find it in today's investments markets a little bit further. Framing the discussion will be Christoph, who is well known to many of you as our head of investments. Christoph has been with the CFB for 16 years. He manages the portfolio of solutions that meet the performance, income and ethical needs of our charity clients. Helping Christoph today are three of our experienced fund managers, Jane, Sophia and Sophie. Jane is a fund manager specialising in fixed interest, is Russian born and a European Jiu-Jitsu champion, so don't mess with Jane. Sophia is a fund manager specialising in equities, who started in our operations team, moved across to our investments team as a trainee, and is now a fully qualified fund manager. Sophie is a fund manager specialising in ethics and has been heavily involved in the huge amount of work and company analysis that we have done on the climate emergency. With today's conference, there will be time for questions at the end, and I will make sure that we finish comfortably before 12:15. Last week I managed the equivalent of 2 minutes before, so comfortably before might be an understatement. It would be really helpful to me in managing the mini conference if you could put your questions into the chat room, either as we go and things occur to you, or at the end. For those who've not used the Zoom chat facility, just click on the chat button at the bottom and type your question where indicated. Finally, can I suggest that you go on to speaker view so that you will be able to see each of the speakers full screen. Without further ado, I will hand you over to Christoph.
Thank you, John. This week, we're going to explore income and how best to get income from our investment portfolios. Now, you'll notice the first slide in today's pack is a gyroscope. It's all about balance. That's there for a reason. I have three of my colleagues who most of you won't know so well presenting today. And one of the themes that will come through their presentations is the need for balance when thinking about cash management and long-term investments. But before we go on to discuss that, let's start with our risk warnings. There's the first of the risk warnings, and there's the second. Our first presentation today is from Sophia, who's one of the fund managers who runs our equity funds, so the UK Equity Fund, Global Equity Fund, and the Climate Stewardship Fund. And she's going to give us some context about the importance of investment income and some of the developments we've seen this year.
Thank you, Christoph, and good morning, everyone. Again, I am Sophia Nelson, and as Christoph said, I work mainly on the equities desk with the UK Equity Fund, Global Fund, and Climate Stewardship Funds. I've also, in the past, volunteered with charities reaching out to the homeless, the poor, the marginalized, and recently I've even started volunteering at a local food bank, which has really given me the opportunity to see firsthand some of the amazing work done by charities. So today, I'm going to talk about investment income and what has happened to it. But before that, I would just like to start with a bit of context about what has happened in the charity sector this year. And up next, you will see a quote from Mark Russell, who is the Chief Executive of the Children's Society. And he said, charities like ours face a perfect storm of rising demand at the same time as income has plummeted amid retail shop closures and cancelled fundraising events. We are specialist church and charity investment managers. And from listening to our customers, we know that the charities you represent are all in different places. So some have seen voluntary donations hold up well, while others have seen them fall. Some are reliant on income from shops, which has dried up. Some on income from grants, which has held up relatively well. Some on income from fundraising events, which have been cancelled. Some on lettings income from the use of your buildings by other community groups. But all of you receive some sort of income from investments. And that is what we're here to discuss today. So if we think back just a few months, at the end of 2019, we had UK markets being quite buoyant and domestically exposed stocks rallied really hard after the Conservative Party won the election. And it appeared that we were finally going to get some certainty and clarity around Brexit. And then early January, news of a virus in China began becoming more prominent in the UK media. And of course, I don't need to tell you how quickly a virus on the other side of the world became a global pandemic. The impact on assets, and in particular equity markets, well, that wasn't pretty. The FTSE All-Share Index fell 36% in a few weeks, but the impact on dividends was even more dramatic. So what we saw the Bank of England stepping in, and it stood behind the entire banking sector. But of course, there was a price to pay. So it ordered all UK banks to cease dividends and put heavy pressure on insurance companies to follow suit. At the same time, we were all forced to stay at home. The weather was pleasant and most aircrafts were grounded. And as a result, there was an abundance of oil and gas, and these prices of these commodities really plummeted. Oil and gas companies cut their dividends to conserve cash. One good example is Royal Dutch Shell, which was very proud of having not cut its dividend since the Second World War. But this year, we saw that company slash payouts by 2/3. The effect of lockdowns and other restrictions affected other sectors as well. We know, for example, the retail sector was particularly hard hit, especially so for those shops offering non-essential goods. We saw the likes of Next, the fashion retailer, and AB Foods, which owns Primark, suspending their dividends. So here I've got a slide which shows the 15 biggest payers of dividends last year in the UK. And on the following slide, you'll see what's happened in 2020. So the companies in red have cancelled their dividends. Those in orange have cut their dividends. Those in yellow have maintained them. And the two in green have increased them. Of course, many of you would recognize the two in green as stocks that we would not invest in because they are ethically excluded. So, all in all, according to Link, dividends in the UK fell by 57% compared to last year in Q2 and by 45% in Q3. Their expectations for the year as a whole are for dividends to fall by roughly 45% to a total of some £60 billion. I must say though, it's not just dividends from equities that have fallen. If we look at commercial property, for example, tenants were given the right over the summer to defer their rents, with landlords unable to serve notice if they did so. In addition, some tenants went into administration or through a CVA process. As a result, rents from commercial property and distributions from commercial property funds fell significantly in Q2 and Q3. And my colleague Sophie will talk about this more in her section, and she will advise, or she will help us to see where current income levels are in equities and property and where they might be heading. Just a quick reflection on bonds. So bond yields have fallen even further this year, which has led to income from bonds continuing their long-term fall. Okay. So on this slide, I've got a couple of quotes, and I'm sure that many of you will be able to identify with at least one of these, where you've had letters from either your bank or your building society saying that the rate on your savings account will be going down, or perhaps your current account will no longer be paying credit interest. This is because, while interest rates in the UK have been low for quite some time now, but with the height of the pandemic and the need to support the economy, Bank of England cut base rates from the already low 0.5% to 0.1%, leading commercial banks and building societies to cut the rates that they pay to savers. And on that gloomy note of what has happened to income this year, I will now hand back to Christoph. Thank you very much.
Thank you, Sophia. A quote from the Children's Society was really telling. When we as investment managers think about charities, there are often two linked but separate issues which we reflect on. One of these is long-term investment, and the other one is cash management. Jane Kochkina, who manages our deposit funds, which many of you use, is going to talk now about cash management and how best to get income from your cash reserves at this time.
Thank you, Sophia and Christoph, and thank you, John, for such kind introduction. Hello, I'm Jane Kochkina. I manage the fixed income and cash funds here at the CFB in Epworth. I'm going to talk today about obtaining income through cash management. This is where one may want to access their funds and their cash, but are looking to put it to work, so some income can still be extracted. So, for cash income, what's important? The biggest issue is security. You just do not want to lose your money. It sounds like such a simple thing, but it's very easy to forget. We can look back in history and the high interest rates paid by the likes of BCCI or Lehman Brothers. Those superficially high rates lured in depositors who then ended up experiencing a lot of pain. We can all remember the amazingly high rates paid by the Icelandic banks in 2008, with even like 7% for instant access. In the end, UK depositors in Kapsien were rescued, while depositors in Landsbanki ended up waiting for years to receive their deposits back. So, there is a need to spend a lot of time reviewing counterparties to make sure that they are creditworthy. It is something that we do a lot here with the banks that we lend to. We have been managing CFB Deposit Fund for almost 60 years. We have never experienced a default amongst our counterparties during all that time. Diversification is also important with this. You just want to make sure that your cash investments are spread across a number of counterparties. So, the next most important issue is liquidity. Just making sure you have access to your money when you need it. Sometimes there can be an attractive one or two year interest rates available. Sometimes even longer. I checked online yesterday. You apparently can get 1.5% if you make a 5-year deposit. But then you would not be able to access your funds this year or 2021 or during the most of 2025. The need for liquidity is also something we take seriously when we manage our cash funds. And we have large balances overnight and on call to enable us to meet the needs of our customers. And then, lastly, we get to yield and the need for income. It is important to look for income. Sophia spoke about just how much Charities needed at present. We spent a lot of time working with our 4 brokers that we speak to and the banks we talk to directly to try and pick up just a little bit of extra return, but not at the expense of security or liquidity. At the CFB and Epworth, we have a CFB and affirmative deposit funds. These offer instant access to your funds and currently still pay a rather attractive rate of 0.3% per annum. As I said, the fund is diversified. We never had a default, and in its history, the fund never closed to withdrawals. Since the start of the pandemic, rates that are available in the market have converged at the very low end. So just in April, I could get over 1% on funds placed in money markets for a year. This is the orange line on the slide. And now we're looking at some very different and rather small numbers you might see there at the bottom right. Unfortunately, as you can see from the chart, the premium for placing money over a longer time horizon, i.e. all the way to 1 year in our case, have been significantly reduced. So I thought I would share a slide going back a bit further to give some greater perspective to the current situation. You can see the rate we have been paying out on CFB deposit fund in blue and how this has been higher than money market rates since the end of 2007. Rates were in a very different environment then. I'm sure many of you can remember paying 10% or higher on your mortgages. One of my predecessors could have spoken to you about the CFB deposit fund paying out a rate of 17%. I said at the beginning that yield is not the most important thing in cash management. That's security and liquidity. But income from cash is still important now. It is not just a drop in the ocean. The extra income compared with leaving your cash in your current account is still something worth having, especially when other funding sources are under pressure. I would also like to finish on a slightly different note. We often hear about ethics and equity funds and about ethics in equity funds. And Sophie and Sophie do a lot of ethical work in managing their funds. But we often don't hear about ethics when talking about cash. We are lucky here to have the Joint Advisory Committee on the Ethics of Investment, JACI, to help us with this. And all of our counterparties are screened for their suitability in the cash funds, just like the equity funds. For example, we recently had a situation with Danske Bank, which was suspended from the lending limit list. Danske Bank was involved in a money laundering scandal, which is an issue many banks seem to be impacted with. But the difference for Danske was the extent of the unacceptable practices across the group and the extent of the issues, as well as the response of the management that was happening. We engage with the banks. We learned on a variety of issues. Recent engagement would be Canadian banks and their lending to fossil fuel companies. All in all, certainly money market rates are low and there are higher rates available elsewhere. ADF fund offers instant access to funds and has its place for clients who have reasons to hold cash. But perhaps for clients who do not have the need for instant access to their money and have no reason to hold too much cash, longer-term investments should be considered. Over to you, Christoph.
Thank you, Jane. There were some bleak-looking slides in there, but as you said, there are still things we can do with our cash reserves. The other side of the coin is long-term investment. Sophie Forrest, who's one of the fund managers running our equity funds with Sophia, is going to discuss where income's available from investments in the current environment and think about whether investing in long-term investments to get income is a good idea. But before she starts, I'd just like to reiterate part of that risk warning. None of this presentation is investment advice. Sophie will be talking in general terms, but if you'd like to discuss your specific circumstances, this is something we can do, though not in this forum.
Thanks, Christoph. Hello, I'm Sophie Forrest, and as Christoph said, I'm one of the fund managers working on the equity funds, along with Sophia and other colleagues. As Jane noted, interest from cash deposits is very low at the moment, and that has led some people to think about other asset classes and whether income from equities or property is for them. Now, firstly, today I'm going to have a look at the income available at the moment in markets, and then think about why it might be worth pursuing or why not. In investment markets, one thing we soon learn is that we can't have our cake and eat it. I have a chart here showing yield across asset classes over 12 months to October 2020. As we can see, the yield provided by lower risk investments, such as cash and bonds, are towards the bottom of the list. As we take on greater risk, you can see the yield on investment increases. Now, please be aware that the yield on the UK and overseas equities is historical. And as Sophia said, dividends have fallen a long way. Miles, our head of research, has done a lot of work on this. And our best estimate is that the prospective yield on the UK equities is between 3 to 3.5% at this point. Now here, infrastructure doesn't have a benchmark or index particularly, so I've shown a range which infrastructure trusts usually sit in. For property, I have taken the yield on pitch, the property trust invested in by the CFP and Epworth, as a proxy for the property market. Sophia spoke earlier about the impact of tenants having the right to defer rent. Pitch is now collecting about 95% of its rent due, and empty properties account for about 8% of the fund value. This has led to a little recovery in distributions and points to how well the fund has managed the impact of the pandemic. UK equities have long had a much higher yield than most other global markets and are undoubtedly one of the main sources of income available. Though we should be aware that that income has come at a cost over the last 12 months, with other global markets significantly outperforming the UK. The main driver of global equity returns in 2020 have been tech companies in the US, which often pay no dividend whatsoever. Sophia talked earlier about the very sharp falls in dividends earlier this year, and I'm glad when we're talking about this now, we can be a bit more hopeful. We have seen some companies reinstate their dividends in the last few weeks, such as Aviva and Lum Securities, and other companies increase their dividends. HSBC has even discussed the possibility of returning to the list of dividend payers at the end of the year. Now, this doesn't mean that we're expecting an immediate recovery from the cuts experienced this year, but it does mean that some kind of recovery now looks likely next year. So we've looked at what income is available at present. Let's have a look at why you might or you might not want to invest in these assets. I thought we'd start with some positives. In terms of returns, we can see on this chart that equities have the highest return. This is looking right from the start of the 20th century to the end of 2019. Now, unfortunately, we don't have property data going back that far, so we just have inflation, government bonds, and equities in our chart. The first bar shows inflation over the time period, compounding at 3.8% a year on average. And then we see what has happened to government bonds. Here, prices have actually fallen marginally over the last 120 years. So let's imagine if you had £100 in 1900 and think about all that could buy you. If you invested it in government bonds, you would have ended up with only £55 or £60 today. The next bar shows equities, and you can see the capital returns. So what happens if you spend your income has been a bit ahead of inflation over that period. And that's despite a couple of recessions and a few world wars. And we can see the effect of compounding very clearly in the last bar, where dividends have been reinvested. Though, given that this is a discussion about income, I'm assuming most of you are wanting to spend it and not reinvest it. This next slide starts to think about some of the risks as well as the returns, and looks at the importance of time frame. We have been talking about these as long-term investments. This analysis assumes you invest at the start of every year since 1900 and looks at whether you would be better off if you invested in equities or just held your money as cash. As can be seen, if you hold your equities for just 2 years, they outperform cash 69% of the time. If you invest for longer, this increases. So if you hold equities for 10 years, this chart shows it outperforms cash 91% of the time. Now, we started on a more positive note, but I thought I would finish on a slightly more sober one. This chart reminds us of the worst market experiences we have seen in recent times. The worst equity setback has been 71% in the UK, against a backdrop of the 3-day week, the miners' strike, and the oil crisis of the 1970s. The worst property market setback has been experienced during the credit crunch just 12 years ago. Had you been invested and a short-term investor, then these would have been very painful losses. And with that, I'll hand back to Christoph.
Thank you, Sophie. Some food for thought there about the extra income that's available from long-term investments. Also, what some of the risks inherent in those investments are. So in today's presentation, Sophia set out some of that context of investment income and what's happened to it this year. Jane's talked about cash management and the income available on deposits. And Sophie's spoken about long-term investments, where income's available and whether we should think about these as a solution to our investment needs. But as I promised at the beginning, both Jane and Sophie have provided us with some balance and thought about what some of the risks involved in seeking higher income might be. I said at the beginning of Sophie's presentation that this seminar isn't investment advice. But if exploring long-term investments is something you'd like to do, then I'd be delighted to chat about that with you later. We can and do build portfolios of these asset classes for our clients who want income, and we'd be delighted to do so for you. And with that, I'll hand over to John now for some questions.
Thank you very much. I haven't got any questions in the chat room as far as I can see. So if anybody's got any questions, perhaps you could just raise your hand or wave, and I'll come to you and ask you to unmute and give me your question. Are there any hands raised? Any questions at all? Oh yeah, I can see Rob Jackson's got a hand raised. Would you like to unmute yourself, Rob, and ask your question?
Yes, I was just wondering, with the current debacle in the United States, what do you think will be the effect on our stock market?
I think I'll pass that one to Christoph to answer. Jane's nodding vigorously, so that decision, Christoph.
Thank you, John. The very short answer to that question is tune in next week at 11 a.m. When my colleagues Stephen and Gareth will be talking a bit more about the outlook for investment markets, thinking a bit about the pandemic and its impacts and where we go from here. Obviously, the US presidential election is a big impact on markets. I think if I can just touch on the income side of life, just to keep it to today's world and not to completely steal their thunder for next week. One of the things which Sophie mentioned was that income from the US is quite low in terms of equity markets. those big tech companies, Microsoft pays a dividend, but a lot of the others don't. And so when we've seen this year's market rise in the US, it's been driven by the likes of Tesla, Google, Facebook, and those aren't dividend paying companies particularly. So in terms of the impact on income, you wouldn't necessarily expect to see a lot of impact on income from markets. The impact on market levels, I think I'll leave to my colleagues for next week. Sorry to slightly duck the question.
Okay, I believe Angela was raising her hand. Angela, would you like to unmute yourself and ask a question? You're muted, Angela, sorry.
Okay.
There we go.
Yes, something that struck me was this picture or these slides where you have inflation and then some lost with gilt, equities and equity totals. It seems like one has to wait 100 years to have something, you know, really nice. So it seems like there is a tension that we need to invest for so many years in order to get something, and yet the needs are now, some of the needs are now. So
Sophie, would you like to take that? I think the question was how long, about really how long we have to invest to make sure that we have a reasonable return from equities in terms of the outperformance of the equities. Is that right, Angela?
No, sorry. Rather than to see how long we have to invest, is that it seems like there is this tension between you need to invest for so many years in order to get a reward, and yet we need something now.
Yeah, I understand. Christoph, do you want to take that, or would Sophie like to take that?
I'd be quite happy to chat.
Okay, yeah, thank you.
So I'll just share the slide. So we've got the slide back that we're discussing. This is the one we're talking about, Sister Angela, is that right? Yeah, okay. So yeah, I think you phrased it very well. There's a tension between the long and the short term in investments. Those long-term returns that Sophie was talking about, so capital growth from equities ahead of inflation, total returns quite substantially ahead of inflation, are long-term returns. You often get short-term risks in markets at the same time. And one of the things we'd all love, I think as an investment manager, I'd love to have it, and I think as investors, everyone in this room would love to have it, was something which gave you high income in the short term, lots of capital growth in the long term, and no risk whatsoever. And that would be the perfect world. And that's what I'd love to be able to offer all of you, and you'd, I'm sure, love to invest in. And there's just that slight tension and holding all of these things in balance. So when we talk about these long-term investments and the long-term growth that's available, there is some income in the short term. Sophie was talking about UK equities, which you'd expect to give good long returns, so there are no guarantees. And we'd probably expect income of roughly 3% from those over the next year. Global equities would be quite a lot lower because of all the factors we've discussed. So there is that tension, and it's always a balance. And when you're thinking about the investments in a portfolio, it's one of the things we think about, is that balance between short-term cash needs and short-term income needs and the needs for long-term growth.
Can I just add something there? I think it really depends also on the nature of your charity, and the nature of and whether you're wanting to fulfill a short-term need, or whether you're wanting to tackle a long-term problem over the long term, and having an investment portfolio can be part of being that sustainable charity, whereas if you're fulfilling trying to fulfill a short-term need, fundraising for that short-term need and delivering on that short-term need is a different thing for a charitable organization. So the whole rationale about whether you should be investing for the short, medium, or long term, if you've got spare resources, I think totally depends on the nature of the charitable activity that you're engaged in. So I've and you know, in terms of Epworth can work with you to give you the profile of the investments that you want to, given the profile of the charity and the needs of your particular charity. I've got a question. I've got a question from Rob Matthews, which is, what is the downside of a no-deal Brexit? What are the most at-risk companies or sectors? Again, probably I think that's an overview question for you, Christoph, if that's okay.
Okay, I'm very happy to chat to that one again. The start of the answer is the same as with the US presidential election, which is that Stephen and Gareth will be talking about this in a lot more depth next week than I'm going to. I'll give you a very short answer here, but they'll be giving a really full presentation on the outlook for markets next week. We've been talking about this for the last 4.5 years, and I've been answering questions about this for the last 4.5 years, and what I've always said is, well, hopefully this time next year we'll have some certainty about what Brexit means. And 4.5 years later, we're still in the same situation of not quite knowing what's going to happen in 6 months' time. And that cycle itself has already had impacts on markets. You can see that the UK is quite cheap if you compare it to other global markets. In terms of if it went wrong, which I think is where your question's directed, and we had a bad no-deal Brexit, and that led to some economic dislocation, where could we see the biggest impacts? The biggest impacts would obviously be domestically, here in the UK. There would be impacts in other countries where people rely on exporting to the UK, but by and large, the biggest impacts would be here. And in terms of when we're thinking about investments and portfolios, what that means is we're thinking about diversification and the importance of not having all your eggs in that one UK basket. And then within the UK, of having exposure to global companies. When you think about some of those companies that Sophia listed in her slide of the top 15 dividend payers, many of those are large global companies which just happen to be headquartered in the UK. They wouldn't necessarily be massively adversely affected by any events. It would be some of the more very domestic companies where you'd have serious concerns.
Thank you. Yeah, that's helpful. Thank you. And if it's as close as I think we can get to an answer at the moment, but I look forward to next week.
I've got a couple of questions from Nandu Patel, who's been kind enough to say that he works for a competitor, but the two questions are good questions, and I think it would be worthwhile to take them. The first question is, when do you think income levels will go back to pre-COVID levels for GDP balanced portfolios? And the second question, is could you please also talk about how permanently endowed charities can navigate this low income environment? Sophie, would you like to sort of take the first one of those, and then perhaps Christoph on the second one of those? So the question is, so Sophie, when do you think income levels will go back to pre-COVID levels for GDP balanced portfolios?
Thank you for the question. I mean, in our presentation, we touched on some of the good news that we've heard recently about some companies starting to reinstate their dividend and others raising it. And I think that has worked out as a kind of lift and a positive outlook for companies for income to go back towards the level that it was previously to COVID. Like I said, I don't think that's going to be immediate, and I think we're looking to a recovery more in the next year and possibly year after as well. As to when it will go back exactly to that level, I can't say, I'm afraid. We'll have to wait and see in some senses, but a recovery more into next year is looking more likely at the moment.
And I think I'd probably add to that if you think about what some of the big drivers of the fall were, you kind of need to start seeing those reversed. So if you think that the central banks globally have largely told banks that they must stop paying dividends, if you want to see dividend levels return, you need to see central banks say to banks, actually, times are better now, you can restore your dividends. That's been a large chunk of the fall. I agree fully with Sophie. Some recovery next year, but a recovery back to previous levels, probably not, at least for 2 or 3 years, I'm afraid. It would be lovely to say it will be back in 6 months, but I don't think that's going to be the case. Could you repeat the second half?
Sorry, the second one, Christoph, is can you also please talk about how permanently endowed charities can navigate this low income environment?
Okay. We could talk for hours about this one. There's a couple of really interesting things to talk about with this one. One of them is that income levels have fallen as the years have progressed. If you think back to the start of my career, which is not that long ago, we used to talk about investing in bonds for income. And government bonds would give you a nice yield of 5% at relatively low risk. They were, with hindsight, really good times to be an investor. These days, we've seen government bond yields shrink all the way down more or less to zero in most developed markets. And that's slightly impacted income from other sources as well. So when we think about permanently endowed charities, so these are charities, if you like, who can never spend their capital, and where the income they receive, if you like, pays for whatever their work is. They obviously want to see a sustainable flow of income out of their portfolio, but they often have that thing that they'd like as much income as they can receive, but with the capital to grow with inflation. That's often the experience as investment managers we get in terms of their requirements. And one of the things that charities like that, often the larger ones, tend to use is something called a total return approach. I don't have the time to go into it in massive detail here, but in effect, what they'll decide is that they'll take out 3% of their portfolio every year, which is historically, or sometimes 3.5% or 4%, depending on the numbers they use, how much you can take out of a long-term portfolio and still meet that requirement for growth in that portfolio to match inflation, so that you're matching today's beneficiaries with the next generation's beneficiaries. And they'll be slightly agnostic about whether they take out capital or income from their portfolio, they'll be willing to take out some of the capital to get to that 4%. So that's one of the approaches which is taken usually by the larger end of the permanent endowment spectrum. All approaches, sadly, in investments have their upsides and downsides, so we could have that conversation. It could take a whole hour-long session, but that's the nutshell of what some people are doing.
Sort of step back from that, Christoph. It's kind of my understanding from working in the charity world that effectively to get that the ability to work on a total return basis for permanent endowed funds, you've effectively got to agree with a charity commission that your permanently endowed funds are X at a point in time, and then you can take the capital growth on top of those permanently endowed funds. And that may be the original donation, or it may be the original donation plus the capital growth that's happened since to the point where you make that agreement with the charity commission. So there are ways essentially of utilizing the capital growth and taking the return on a total return basis rather than just the income return from an endowed fund. So that's something that charities with large endowments have considered and have done at the larger end, but it might be worth considering for other charities who've got permanently endowed funds to fix that and then be able to have the option of taking the capital growth as income effectively. Don't see any more questions in the chat room at the moment. Are there any other questions or of people? Don't see anything else. I think we've exhausted you all. So unless anybody starts waving madly, I said we would finish by 12:15 at the latest, and I think we can do that now. So really,
John, sorry, Brian Roberts seemed to be waving at us.
Oh right, thank you very much, James. Brian, would you like to unmute yourself and ask a question?
I've been trying to send you a question or at least a comment, and the chat room just will not work. So I've
just got it here. I've just got you started here. Yes. Okay. Thank you, Brian.
Thank you, Christoph, and the team for all the helpful information. Thank you very, very much.
Okay. Thank you very much for that. Thank you, Brian. I was just winding up and to say, firstly, I would like to say my personal thanks to the team today. I know how hard they've worked on this presentation, and thank you very much for what has been a really interesting and enjoyable session. So thank you very much for that. Second thank you is to thank you all very much for coming, and the third thing is to remind you that we will be having our third seminar next week at 11 o'clock, and I look forward to welcoming you all again to that seminar. So thank you very much, and we'll finish the proceedings here. Thank you again for your attendance.